In this video, I'm going to give an update to my business cycle risk score analysis. We're talking August 2019 now, and I wanted to share with you the latest update because it is certainly telling a certain story that I think I really need to share with anyone who's watching this, and you might agree with me by the end of this video that it is quite interesting what it is showing at the moment. If you are new to my channel, my name is Jared Ayers. I am a CFA charter holder. I've created this channel to share with anyone who's interested the ideas, strategies, techniques, and thought processes that I go through when managing my own money. I've been doing that for about 20 years now, done pretty well for myself, and have created this channel to share those ideas. So before we jump into the analysis itself, I will mention that in previous videos I have laid out exactly my processes for going through and calculating the risk score, looking at the economic indicators that I'm going to go through in this video, and in quite a bit of detail illustrating how I look at them and how I analyze them. I will link to the videos and playlists in the description of this video so that you can refer back to those other videos if you wish. But in this video we're going to move through at a fairly decent clip as previously done for these updates, and just basically highlight the main things that I'm looking at and ultimately what I believe these indicators and analysis are showing me. So without further ado, let's jump into the analysis. So as mentioned, what you see in front of you is a capture of my screen. This is my business cycle risk score analysis calculation for the 15th of August 2019. You can see here that the score itself is fairly low in absolute terms, -26 on a scale of 1 to 10, 0 being the worst and 10 being the best. 1.7 is not an excellent score by any means. Like I mentioned, I will be linking back to how I do all these calculations, but as a quick reminder, I do categorize my 13 indicators by whether they're leading or lagging. Leading indicators getting a greater predictive power score than lagging indicators. The date of, or the most recent date of the data used for this calculation is also considered, where the information is very current. It gets a higher percentage or total weighting. Where the data is a little bit older, it gets less of a weighting. So you'll see that as we go through here. With that, then I come to a total weight. And looking at each indicator individually, I'm looking to see if which direction it's going, and also what is the rate of change. Then that gets me into an absolute score, which I then convert to a 10-point scale, and that gives me a quick reading so I know kind of where we are from a business cycle standpoint and whether we are in a place where I should be using extreme caution or getting very bullish and acting accordingly, and of course anywhere in between. So that's the summary for August. Not great. If we go and take a peek then at the first indicator, the 10-year versus 2-year yield spread, you can see here again what we're looking for in this indicator is when it basically goes negative. So when the 10-year yield falls below the 2-year yield, that's often been a predictor of a recession in the next 6 to 18 months following that point. As you can see here, we've seen a pretty sharp drop off in that spread, where intraday I think it did actually go negative. Certainly got very, very close to zero on the close. So this is not a good sign. The yellow line, of course, is the 90 or the trailing 90 period average. The gray line is the 30 period average, and the blue line is the current data. So you can see it just sort of plunged there. Not a great sign, as we see on this indicator. The next one, GDP growth, not really terrible. I mean, this data is a little bit stale. The last GDP numbers would have been for June, so not super current, but definitely in a trend where it is coming off. Still, I think GDP did exceed expectations, but the overall GDP numbers have been sliding a little bit as of late, so not, again, not a great trend if we're thinking that we are in a good situation right now. Producer inflation. So this again has to do with producers of goods and services, the inflation rate. As you can see in the past, as we approach sort of the recession times, this would have been the 2000 bubble, this had been the 2008 crash. You can see that inflation sort of ramps up and then comes steeply down. And even preceding the recession, it has a tendency to roll over. The way I calculate my analysis, when we're seeing producer inflation rates start to trend down, I'm saying that that's not a good thing. So that's what this analysis is showing, is that sort of on a trending basis, and the gray line being the 12-month moving average, the orange line being the 4-month, and the blue line being the current data, all are kind of moving in a downward shape there. So not typically a great sign if we look back into our history here. Fed funds interest rate. So this is an interesting one. It's fairly clean. If you look back, you get this sort of run up, you get a table, and then you get a drop off. And you get a run up, you get a table, you get a drop off. And those drop offs usually happen because the economy is cooling, and the government is usually a little bit late in making that adjustment. You can see here we've had a run up, we've had a little bit of a table, and now a quick drop off. So obviously this is early days, it may correct itself, but as you can see in past trends, those things are, they look fairly clean in terms of their the trajectory that they take. So this really isn't a great looking chart from a Fed funds interest rate perspective either. Consumer inflation. So this is the CPI effectively year over year in the US. Again, if we're looking at interest rates and indications of an economy that is cooling, this is an indicator that may lead us to conclude that exact fact. Obviously in the past it's come off before and not really meant anything. Other times it has. I tend to believe that in a when you're starting to see inflation cooling off like that, that's usually indication that interest rates need to be cut in order to support that. When interest rates, or when inflation is rising, you may see interest rates rise as well as the economy heats up, just to try to cool it down. But certainly when that inflation level starts to turn, that can be an indicator that we're heading for an environment that's maybe less than positive. Jobless claims. This indicator is really not showing too much. Unemployment's very low, jobless claims still very low. I would call that kind of flat, and really isn't showing any kind of bad trend. We know it's a very, very strong labor or unemployment market right now. It's very, very low unemployment, and nothing is showing yet in the jobless claims arena to indicate that anything is worth being scared about. So that's actually a positive out of this whole thing. Same with the unemployment rate. So like I said, extremely low unemployment. The jobless claims actually usually are a leading indicator for unemployment, and unemployment obviously is not showing any signs of going higher either. However, I will point out that generally labor is one of the last lagging indicators to react to economic conditions. Even in worsening situations, employers will generally hang on to labor or employees the longest before cutting them, only because of the cost of rehiring, etc., training, what have you. So this is not really a bad sign, but then I wouldn't probably expect it to be leading in that case. Looking at the non-manufacturing PMI indicator, again, this is a survey-based indicator for the purchasing managers in the non-manufacturing space. The indicator is showing, again, in whether it's current data or 12-month trailing, that everything is going to be sort of trending down. With this indicator, the threshold sort of to indicate that you're heading towards a recession is that 50 point. So right now it's sort of heading below 55, sharply heading down. Don't know if it's going to get to 50, but certainly, you know, as you could see in the past, you know, that trend heading down, certainly before it crosses, you know, can be an indicator that we are heading for less than favorable business cycle environment. Looking at the business confidence, or the PMI, this would be a similar survey-based indicator for the manufacturing sector. Again, you know, looking at the data points, same idea. They're heading down. The threshold is still 50 for this type of, or for this particular indicator. As you can see in the past, you know, as you're heading towards that 50 line, it doesn't often look good. And you know, these are basically the purchasing manager's own beliefs on the health of the economy as it relates to business. So not really a great looking chart at the moment. Consumer confidence. This one is not really in the danger zone, in my opinion. It's continued to come up and basically gone sideways. You want to see that sort of come off, although, you know, it is on my list as a leading indicator, but can be sort of you know, at a peak for a little while prior to rolling over and coming down. In the past, you can see, you know, as consumer sentiment breaks, you know, that usually relates to reduced retail sales, etc. So right now, not in really a terrible spot, but something to watch closely as we continue on here in the coming months. And of course, retail sales, which obviously is driven by consumers. This indicator is, at least on a 12-month trailing basis, really not showing a ton of health. It is coming off. On a 4-month or current data standpoint, it's hard to see really what the trend is. I mean, you can see it's come off sharply and then recovered. It's hard to see if that recovery is going to be sustainable or not. Certainly on a trailing 12-month basis, it is sort of continuing to deteriorate. So something to watch as well as we move forward. Not a great sign is if the retail sector begins to show signs of stress. Then we come, of course, to the 10-year Treasury yield. This is somewhat related to the spread between the 10-year and the 2-year. This is just the yield on the 10-year Treasury in absolute terms. As you would expect, with the spread between the 10-year and 2-year narrowing to basically negative, the yield on the 10-year has come off sharply. With this indicator, it's those sharp moves that you kind of want to pay attention to. In this instance, you know, what could be driving that? I mean, certainly it's been in the past, people will seek safety in long-term Treasury bonds. That's what drives the demand up. That also therefore drives the price of the 10-year Treasuries up, and of course reduces the yield, because the yield is a function of price. So as the yield sharply comes down here, that can be an indication that money may be flowing out of the equity markets, as people maybe are preparing for a less than favorable coming business cycle in the next coming months. So again, this is just as a quick snapshot of the risk score calculation as it was at June. So only 2 months ago, the risk score was showing kind of 4.9. So a few positives in here, not too many negatives, a few that really didn't have much weight at all, kind of neutral effectively indicators. So 4.9 on a 10-point scale, pretty close to even. You can see the absolute score being 0. Then in July, risk score falling from 4.9 down to 3.4. Some more stresses showing in certain indicators, and then of course that brings us to August, and a lot more negativity. So this is actually quite a sharp turnaround. I've not seen this happen very often at all. Certainly back in kind of November time of 2018, preceding the December sell-off, there was some stresses showing, but that wasn't really, none of those were really sustained, and it wasn't certainly as dramatic as this. So it's quite interesting from my perspective to see this, and I guess the next question, of course, is then what does that all mean? As I've mentioned in the past, I do take the risk scores and I look at them in terms of where they sit on that range, and I have sort of a range of asset allocations based on what the score is. So you can see the table here, and of course we're down in this lower section here now at a rating of 1.7. So I mean all these percentages based on asset classes all relate to the minimum column. So if you're in a 1.7, you're kind of in between. So you're not necessarily quite at 0 yet from an equity standpoint, but definitely very cautious is what this score is telling me to be, and especially from a risk standpoint and an asset allocation on the defensive side is definitely what I'm seeing right now. So just to recap, the three scores, June, July, August, 4.9, 3.4, 1.7, how that changes specifically those specific scores in terms of asset allocations, going from almost 60% equities down to 9%, going from 1% bonds to 25% bonds, going from 35% cash to 50% cash, going from 5% gold to 8% gold, and going from 0% managed futures to 8% managed futures. So that's telling a story, certainly. What does that mean I'll be doing at this stage? Quite frankly, given my risk-averse nature and what this is showing me, in just to use a metaphor, I'm probably going to be, gathering my things and moving slowly and calmly towards the exits ahead of the mad rush. To use another analogy, maybe from weather standpoint, you're sitting on the beach and it's nice and sunny. You can see some clouds rolling in. The skies haven't opened up into a torrential downpour yet, but what I'm seeing is those clouds are rolling in. I can see a fog in the distance that looks like rain. It's coming, and I prefer just to gather my things and seek shelter until I either determine that the clouds and rain are not coming and I can return back, or let them come, empty out and then clear out, and I'll happily go back to the beach. Of course, we're not talking about actually the beach itself, we're talking about money, and my number one rule and objective when I invest my money is to keep what I have. So this may be, or may appear to be, a very conservative approach to managing money, but for me it works, and it lets me see, or at least gives me a tool to see out ahead of sort of the very near term, and helps me plan and decide where to put my assets. There's a lot of noise out there, a lot of tweets, a lot of media attention, a lot of headlines, and this again just gives me a way of cutting through all of that, reading the data. Again, this isn't a prediction, it's just looking at what the data is telling me right now. this is what the data is saying. Right, wrong, good or bad, what I think, what my intuition tells me, what my neighbor has, the success he or she has had, doesn't really mean much to me. I always come back to the data. I have to trust it. It's non-judgmental, it's non-emotional. It just tells me something, a story that I can do with whatever I want. So this is how I choose to use it, and right, wrong, good or bad, I may lose out if this is false, but at the same time, I'll be watching this over the next few months, and of course if it course corrects and changes back and heads the other way, then that's fine too. I can always step back in, but for now I'm going to probably move, at least edge my way towards this type of allocation here on the bottom, and see what happens. So you can do whatever you want, of course, yourself, and by all means let me know as well. So I hope you found that video useful. Certainly when I saw the data, when I updated it in August, it certainly told me a story that I thought I should definitely be sharing. Again, I am, these indicators and how I use them to allocate my own assets are exactly that. They're my decision to do with my own investments what I choose. I don't want this to be taken as advice or a recommendation. I just wanted to share with anyone who's interested, of course, exactly what I do and how I think about allocating my assets and what indicators I do follow to help me understand what might be going on. So if you have a different approach yourself, by all means let me know in the comments. I'd love to hear about it. It may be better than mine, you never know. I can maybe even pick up some advice from others out there watching me as well. If you did like the video, please by all means give me a thumbs up. If you are new to my channel and you haven't yet subscribed but you'd like to see more of the same type of content, by all means hit the subscribe button. And of course, anything else you want to comment on, good, bad, or ugly, I'm always open to feedback and suggestions. So until next time, thank you very much for watching.